This expense report is denied due to insufficient documentation and questionable business necessity. That's what appeared in my expense management system on a Monday morning in June 2024, rejecting the $3,247 I'd spent on client entertainment and travel during a critical deal negotiation, with the bureaucratic finality of someone who decided that denying a senior employee's legitimate expenses was an effective demonstration of financial discipline. Insufficient documentation and questionable business necessity. I'd been Senior Director of Business Development at Velocity Tech Solutions for 6 years, managing enterprise client relationships and negotiating software licensing deals that generated $15 to $20 million annually, following the same expense protocols I'd used for years to wine and dine executives at Fortune 500 companies who expected high-touch relationship management before committing to multi-million-dollar contracts. But according to Gregory Chen, our CFO who joined Velocity 8 months earlier to prepare the company for IPO readiness, my expense report from the Salesforce deal negotiation didn't meet his new stringent documentation standards, and he'd decided that publicly rejecting a senior director's expenses would signal to the organization that nobody was exempt from his financial controls, not even the people generating the revenue that made an IPO possible. I'm Samantha Brooks, and I stared at that expense denial while knowing exactly what expenses Gregory was actually hiding in Velocity's books and exactly what would happen when IPO auditors started reviewing financial controls at a company whose CFO blocked legitimate business expenses while approving his own questionable spending. 6 years, 8 months, and 14 days of closing deals that kept Velocity growing at 40% annually, building relationships with enterprise clients who trusted me to deliver on promises, and Gregory had decided that my documented client dinners were somehow less legitimate than the executive perks he'd been charging to the company. I wasn't the CEO who set company strategy or the CFO who managed finances. I drove a 2021 Tesla Model 3 with 48,000 miles on it and client relationship notes in my center console because I reviewed account strategies during my commute to prepare for calls. I lived in a condo in San Francisco with a home office containing deal files, contract negotiations, and relationship timelines for every major client I managed. I was strategic about client relationships, methodical about documentation, protective of the trust that enterprise executives placed in me when betting their careers on Velocity's technology. And apparently my $3,000 expense report was questionable to a CFO who'd been expensing 5-star hotels and first-class flights while preaching fiscal discipline to everyone else. The trouble had started 8 months earlier when Velocity Tech Solutions had hired Gregory Chen as CFO to prepare for an initial public offering. Velocity had grown from startup to profitable software company with $87 million in annual revenue, and the board wanted to take the company public to provide liquidity for early investors and raise capital for expansion. Gregory's mandate was to implement financial controls, improve reporting systems, and prepare Velocity for the scrutiny that comes with being a publicly traded company. Gregory came from investment banking where he'd advised tech companies on IPO preparation. He had that aggressive cost control mindset, talking about expense discipline, margin optimization, and eliminating discretionary spending, that sounded impressive in board meetings but created problems when applied without understanding how business actually generated revenue. His first initiative had been implementing stricter expense policies requiring detailed documentation, pre-approval for client entertainment above certain thresholds, and centralized review of all expense reports by finance before approval. The new policies weren't inherently unreasonable. The problem was how Gregory applied them, strict enforcement for everyone else while his own expenses sailed through with minimal documentation. In November 2023, I'd noticed that Gregory had expensed $12,000 for a financial advisory conference in Miami that included luxury hotel stays and high-end restaurant bills. When I'd asked our VP of Finance about it, I was told that CFO expenses didn't require the same level of scrutiny as other employees because executive entertainment often served relationship-building purposes that weren't immediately obvious. Meanwhile, my expense report for a client dinner in Chicago, a carefully documented meal with the CTO of a healthcare company where I'd been negotiating a $4.2 million software deal, had been kicked back 3 times for insufficient business justification, despite including meeting notes, attendee names, and deal context. The double standard was obvious. Gregory's expenses were assumed legitimate regardless of documentation, while my revenue-generating client expenses were scrutinized as if I were trying to defraud the company. By June 2024, I'd been working on the Salesforce deal for 7 months. Salesforce was evaluating Velocity's analytics platform for enterprise-wide deployment across their sales organization. The deal was valued at $8.3 million over 3 years, one of the largest contracts Velocity had ever pursued. The negotiation involved multiple stakeholders at Salesforce, including their VP of Sales Operations, their CTO, and their Chief Data Officer. These were senior executives who expected relationship investment commensurate with the deal size. During May 2024, I'd flown to San Francisco twice for in-person meetings with Salesforce executives. I'd hosted dinners at high-end restaurants where we discussed technical requirements, implementation timelines, and integration challenges in settings where executives felt comfortable being candid about concerns. I'd taken the Salesforce team to a Giants game in a suite where we built personal relationships beyond formal business discussions. All of this was standard enterprise sales practice. Major deals require relationship investment, and enterprise executives expect vendors to demonstrate commitment through face-to-face interaction and hospitality. Total expenses for May, $3,247 including flights, hotels, restaurants, and the Giants game suite. Every expense was documented with receipts, attendee lists, and business context explaining how each activity advanced the Salesforce negotiation. I submitted the expense report on June 3, confident it would be approved routinely like my previous expense reports. On June 10, the expense report was denied. Gregory's rejection note stated, "Expenses appear excessive for routine business meetings. Documentation does not sufficiently justify luxury dining and entertainment. Please resubmit with more conservative expenses or provide additional business justification." This was absurd. You don't close an $8 million deal with Salesforce executives by taking them to Applebee's and asking them to trust you with enterprise-critical systems. But Gregory had decided my expenses were his opportunity to demonstrate financial discipline. I responded to Gregory's denial with additional documentation, the Salesforce deal timeline, the specific executives involved, their seniority levels, competitive context showing that other vendors were also investing heavily in relationship building, and the $8.3 million contract value that justified $3,000 in relationship investment. I explained that enterprise sales to Fortune 500 companies require significant relationship development and that the expenses I'd incurred were not only appropriate but necessary to compete effectively. Gregory responded, "Business development expenses must be justified by closed revenue, not potential deals. Until Salesforce signs a contract, these expenses are speculative investment that doesn't meet our documentation standards." Expense report remains denied. Now about 81% of you think I'm about to expose Gregory's expense hypocrisy or report him for favoritism, and you're wrong. Subscribe right now, because what actually happens is that IPO auditors don't just review revenue and profitability, they examine expense controls and financial governance to verify that companies have proper systems before going public, and CFOs who play favorites with expense approval create exactly the kind of control weaknesses that delay or block IPOs. After Gregory denied my expense report in June, I made a decision. I could escalate to the CEO or board, complaining that Gregory was being hypocritical and unreasonable. Or I could document everything carefully and let the IPO audit process discover what I already knew, that Velocity's expense controls under Gregory were inconsistent, subjectively applied, and demonstrated poor financial governance. I saved all correspondence with Gregory about the expense denial. I documented the Salesforce deal context showing that the expenses were legitimate business development costs. And I quietly noted other instances where Gregory's enforcement of expense policies seemed arbitrary and self-serving. In July 2024, Velocity Tech Solutions formally began the IPO preparation process. The company engaged Deloitte as their auditing firm to conduct the financial audit required for SEC registration. IPO audits are comprehensive examinations of a company's financial controls, accounting practices, and internal governance. Auditors review not just financial statements but also the systems and processes that generate those statements. One area that IPO auditors scrutinize carefully is expense management and internal controls. They want to verify that companies have proper systems for approving expenses, that those systems are applied consistently, and that there's adequate documentation supporting business expenses. Weak expense controls suggest broader governance problems that create risk for public investors. In August 2024, Deloitte's audit team began their Fieldwork at Velocity. They requested documentation of expense policies, samples of expense reports, and evidence that expenses were properly approved and documented. As part of this review, they examined expense reports from senior executives and department heads to verify that high-dollar expenses had appropriate business justification. One of the expense reports selected for audit sample was mine, the $3,247 report that Gregory had denied in June. The auditors reviewed my documentation showing the Salesforce deal context, the relationship-building activities, and Gregory's rejection stating that the expenses were excessive and speculative. The auditors also reviewed Gregory's own expense reports. They found the $12,000 Miami conference expense from November 2023. They found multiple instances of luxury hotel stays and first-class flights that Gregory had approved for himself with minimal documentation. They found patterns suggesting that Gregory enforced strict documentation standards for other employees while his own expenses received cursory review. In September 2024, Deloitte's audit partner, Jennifer Walsh, requested a meeting with Velocity's CEO, Michael Torres, and the audit committee of the board. Jennifer explained that the audit team had identified potential internal control weaknesses related to expense management. Specifically, there was evidence that expense approval was inconsistently applied, with the CFO denying legitimate business development expenses for revenue-generating employees while approving his own discretionary expenses with less rigorous documentation. Jennifer provided specific examples. My denied Salesforce expense report compared against Gregory's approved Miami conference expenses. The auditor's concern was that this inconsistency suggested either poor judgment by the CFO or intentional favoritism, and either scenario indicated weak financial controls that needed to be addressed before the company went public. Michael Torres asked for details. Jennifer explained that my expense report included comprehensive documentation linking expenses to an $8.3 million deal negotiation, while Gregory's Miami conference expense included minimal documentation and unclear business purpose. Yet Gregory had denied my report as insufficiently justified while approving his own. This created questions about whether Velocity had adequate controls over executive expenses and whether the CFO was exercising appropriate judgment. In financial governance, the audit committee asked Gregory to explain his expense approval decisions. Gregory tried to argue that business development expenses for unclosed deals were speculative and required stricter scrutiny than executive expenses related to maintaining industry relationships. The audit committee asked whether Velocity had written policies distinguishing between these expense categories. Gregory acknowledged that no such written policy existed. His different standards were based on his judgment. Jennifer explained that inconsistent application of expense policies without documented criteria was a material internal control weakness. For an IPO, this weakness would need to be disclosed to the SEC and potential investors as a deficiency in financial controls. Such disclosures made companies less attractive to investors and could delay or even prevent successful IPO completion. Over the next 2 weeks in September, the audit committee conducted their own investigation. They reviewed expense reports from multiple executives and senior staff. They found additional patterns of inconsistent approval where Gregory had denied legitimate business expenses for employees while approving questionable discretionary spending for himself and other executives he favored. In one case, a sales director had been denied expense reimbursement for a client golf outing while Gregory had approved his own expense for a similar golf outing with financial community relationships. In another case, a marketing manager's trade show dinner expenses were rejected as excessive, while Gregory's dinner expenses from the same trade show were approved without question. The pattern was clear. Gregory enforced strict standards on operational employees while applying lenient standards to himself. This wasn't just poor judgment, it indicated that Velocity's CFO was using expense policy enforcement as a tool for organizational control and favoritism rather than as objective financial governance. On September 24, 2024, Deloitte issued a management letter to Velocity's board identifying material weaknesses in internal controls over expense management. The letter stated that expense approval was inconsistently applied, that the CFO had denied documented business expenses while approving less documented discretionary expenses, and that these weaknesses would need to be remediated before Deloitte could provide an unqualified audit opinion supporting the IPO. The management letter effectively blocked Velocity's IPO timeline. The company couldn't go public with disclosed material weaknesses in financial controls. Investment banks wouldn't underwrite the offering. Investors wouldn't buy shares. The IPO that Gregory had been hired to enable was now delayed because of weaknesses in the very financial controls he was responsible for maintaining. On September 27, the board held an emergency meeting to discuss the audit findings and their implications. Present were Michael Torres, the board members, Gregory Chen, and myself. I'd been asked to attend because my expense denial was one of the examples cited in the audit report. The board asked me to explain the business context for my Salesforce expenses. I walked through the 7-month negotiation timeline, the senior Salesforce executives involved, the competitive dynamics requiring relationship investment, and the $8.3 million contract we'd signed in July, 1 month after Gregory denied the expense report. I noted that the $3,000 Gregory had deemed excessive had been instrumental in closing a deal generating $8.3 million in revenue, which represented a return on investment of approximately 2,700 to 1. The board asked Gregory why he denied my expense report. Gregory tried to explain his reasoning about speculative expenses for unclosed deals. One board member interrupted, "Gregory, Samantha's expenses were for a deal that closed in July generating $8 million in revenue. Your Miami conference expenses were $12,000 for a trip that generated no identifiable business value. Why did you approve your own expenses with minimal documentation while denying Samantha's well-documented revenue-generating expenses?" Gregory didn't have a good answer. Another board member asked Jennifer Walsh from Deloitte, "What would it take to remediate these control weaknesses so we can proceed with the IPO?" Jennifer explained that Velocity needed to implement consistent expense policies with clear written criteria, apply those policies uniformly to all employees including executives, conduct additional audit testing to verify the new controls were working, and potentially restate prior period expenses if the inconsistencies had materially affected financial statements. The board asked how long remediation would take. Jennifer estimated 4 to 6 months to implement new controls, test them adequately, and complete additional audit procedures. This meant Velocity's planned Q4 2024 IPO would be delayed until at minimum Q2 2025, a 6-month delay caused by control weaknesses in expense management. On October 2, 2024, the board terminated Gregory Chen as CFO. The board concluded that Gregory had demonstrated poor judgment in financial controls, had created material weaknesses that blocked the IPO, and had damaged credibility with auditors through inconsistent policy application. The board appointed an interim CFO and began searching for permanent leadership who understood that financial controls needed to be applied objectively and consistently. On October 8, Michael Torres called me into his office. "Samantha, I've reviewed what happened with your expense report and the subsequent audit findings. Gregory's denial of your legitimate business expenses triggered the audit scrutiny that revealed broader control problems. You documented everything properly, you followed appropriate business development practices, and you closed a major deal that Gregory then used as evidence that your expenses were unjustified. The board wants to recognize that your professionalism throughout this situation helped identify serious governance issues before they became public problems." I was promoted to Senior Vice President of Strategic Accounts, reporting directly to the CEO, with expanded responsibility for all enterprise client relationships over $5 million. My salary increased from $158,000 to $225,000, a 42% increase. I also received accelerated vesting on stock options that would become extremely valuable when the IPO eventually happened. On October 15, Velocity issued a company-wide email announcing new expense policies with clear documentation requirements, consistent approval processes, and equal application to all employees regardless of seniority. The email noted that these policies were being implemented as part of IPO readiness initiatives and represented Velocity's commitment to strong financial governance. In December 2024, I saw Gregory at a CFO networking event. He was working as an independent financial consultant, trying to rebuild his reputation after being terminated from Velocity. He approached me cautiously. "Samantha, I heard about your promotion. Congratulations." I looked at him directly. "I got promoted because I documented legitimate business expenses properly and closed major deals that drove company growth. You got terminated because you denied my well-documented expenses while approving your own questionable spending, and when auditors reviewed your expense approvals, they found material control weaknesses that delayed the IPO you were hired to enable. Gregory tried to defend himself. I was implementing stricter expense controls to prepare for public company scrutiny. Sometimes that means making tough decisions about discretionary spending. I responded, you weren't implementing controls, you were playing favorites. You denied my $3,000 in documented deal expenses that helped close an $8 million contract, while approving your own $12,000 in conference expenses that generated zero business value. That's not financial discipline, that's poor judgment and inconsistent governance. And when Deloitte examined your expense decisions, they found exactly the kind of control weaknesses that block IPOs. Gregory walked away without responding. The IPO eventually happened in May 2025, 6 months later than originally planned. The delay cost velocity momentum and potentially affected valuation, but the company went public with strong financial controls and clean audit opinions. My stock options vested at IPO, and between the promotion and equity value, that $3,000 expense report that Gregory denied ended up costing him his career while generating over $2 million in personal wealth for me. Here's what nobody tells you about petty power moves: sometimes the thing you block isn't the thing that matters. Gregory thought denying my expense report proved he was serious about financial discipline. What it actually proved was that he didn't understand the difference between legitimate business investment and personal discretion. And when auditors started asking questions, they didn't just find my denied expense, they found a pattern of inconsistent judgment that revealed exactly why he wasn't ready to lead finance at a public company. So next time someone in power decides to make an example out of you, remember this: documentation beats authority. Every time. The expense report I submitted had more integrity than the CFO who rejected it. And when auditors had to choose between my paperwork and his judgment, they chose facts over ego. Subscribe if you've ever had legitimate work blocked by someone on a power trip. Comment if you've seen petty decisions spiral into career-ending consequences. And remember, the thing about glass houses isn't that you can't throw stones. It's that when auditors show up with clipboards, your windows better be clean.